Hello, and welcome to the Francis Financial Investment Insights for February 2023. My name is Peter Vilim, and I am a Senior Associate Advisor at Francis Financial, and it's my pleasure to welcome you here today to talk about some of the trends that we've been seeing in our clients' portfolios and the market at large over the past handful of months, and some of our thoughts as we continue to venture into the first quarter of 2023. And to start, we've seen a very strong rebound from last year. 2022 was a year to forget for a lot of investors with declines across most asset classes. But what's great to see to start the year in the first month of 2023, strong returns across essentially every single asset class. You'll see international stocks, which had a very strong end of the year in 2022, continue that trend with an almost 8% return to start the year. US small company stocks also performed well to start the year with returns of about 10% and a little bit of a reversal where we saw growth stocks, think your Teslas of the world, perform well with about an 8% return in comparison to US large cap value stocks, which are some of those stabler dividend paying stocks. Think your Johnson & Johnsons didn't do as well as they were or as they performed in 2022, but they also still had a strong start to the year with a return of almost 5%. And it's great to see coming off of the heels of that harder 2022, these positive returns. And the question is, what is driving some of these positive indicators that we've seen to begin this year and what we see going forward? And at its core, one of the main things that we are seeing is inflation is starting to taper at least a little bit. So towards the middle of last year, when the market was at its lowest, we saw inflation only beginning to rise. So you saw to begin the year was at that 7.5%, and it continued to trend up until towards the middle of the year, where it reached that a little over 9%. And from there, month in and month out, we're seeing this slow but steady decline in some of those inflation rates. And what this translates to is higher inflation means that the Federal Reserve will, in a reaction, raise interest rates to get some of these numbers in control. And in part, why we began to see this decline is because the Federal Reserve, throughout numerous different instances last year, was raising interest rates almost 0.75% at each meeting. And towards the end of last year, what we saw with that decline, the Federal Reserve was saying, hey, we don't necessarily need to be as aggressive with the amounts that we're raising. Instead of raising it 0.75%, let's raise it just 0.25%. And seeing the Federal Reserve begin to ease up on some of those interest rate hikes gave some positive sentiment to many investors to say, you know what, maybe the light is beginning to appear at the end of the tunnel in terms of inflation, and we have a little bit more certainty as to what some of these numbers could look like in the future. So that was one really strong driver of that positive return that we saw to begin the year. Another one was jobs. So one of the benefits that we've seen throughout the market so far this year has been this strong growth, despite hearing some of these news about layoffs in big companies. There has still continued to be strong wage growth, which is great for job seekers. However, there may be some concerns on the Federal Reserve side that these strong job results may be an indicator that inflation might not fully be over the hump yet. However, it is great to see that some of these underlying figures of the economy are strong, and that over the course of last year and the last 12 months, there have been nearly 5 million jobs added. So there is a lot of strength still within the US economy, despite some higher than typical inflation rates. And with some of those higher inflation rates too, one trend that we did see was increasing mortgage rates. If you were fortunate enough to refinance back in 2021, interest rates were particularly low. And how that translated to, if you look at the beginning of the year, some of those 30-year fixed income or those fixed mortgage rates were close to about 4%. But as investors began to see that inflation was going to continue to be higher than anticipated, you could see that these rates continue to creep up. And then they reached their peak towards the end of last year in November, but we're starting to see those numbers taper off as we get a bit more clarity with inflation and as the Federal Reserve begins to decrease some of those inflation rates, or at least the rate at which they are increasing them. So that is another indicator that we see that some of the light may be at the end of the tunnel. And this stronger mortgage rates, as well as the job reports, might show that the U.S. is in line to potentially avoid a recession in 2023 or achieve that quote unquote soft landing by slowing growth just enough to be able to lessen the effects of inflation and get that number a little bit under control, while still providing enough liquidity in the market to keep unemployment at historically low rates, and potentially give some potential mortgage buyers some more flexibility to achieve a bit better rate to be able to use those on other things that they might want to purchase. And so in total, it's great and phenomenal to see the year start on that positive note. Seeing returns across every asset class be positive is rare, especially coming out from a year such as last year. And on top of that, even though earnings have a mixed start to the year with several companies laying off some substantial amount of employees, we did see that many new jobs were created despite some of these scary headlines. And with that, we anticipate a continuation of these choppy market conditions until we get a little bit more information about the Fed getting inflation under control, and once we reach that true peak of interest rates. And how that translates to us is, in this environment, we're always looking to maintain that course, rebalance when necessary, keep that diversification optional, while maintaining appropriate levels of risk to take advantage of this recovery as the market continues to develop. And with that, that is the January leading into February 2023 market commentary. If you have any questions, please don't hesitate to reach out. My email is peter@francisfinancial.com. And as always, you can call us at 212-374-9008. Again, it was a pleasure being able to go over some of this with you, and we look forward to talking this over and addressing any questions that you might have. Thank you, and have a great rest of your day.